So in this lesson, we're going to be looking at pips, lot size, and spread. We're also going to be looking at risk management. Section 1. So what is a pip? A pip is simply a small unit used to measure how far price moves. Let's look at this. When price moves from 1.1000 to 1.1010, that is 10 pips. And that small movement is where your profit or loss comes from. Now, if you look at this picture, you see that there are some numbers displayed here. Okay, and then you have, for example, if you look at the number, you see that 4 represent 4 pips. So 1 pip is equal to your fourth decimal place, right? So, and then you have 3, which is 30 pips, and then you have 2, which is 200 pips. You also have 1, which is 1000 pips, and then you have 1 point, which is 10,000 pips. And then there is a last one, which is 5. Now this 5 here is actually 0.5 pips. Okay, so if price moves in your direction, you make money. If price moves against you, you lose money. So the more pips price moves in your favor, the more profit you make. Section 2. Lot size, the money control. So what is lot size? Lot size controls how much money you make per pip. Same movement, but different lot size gives different result. That means your lot size controls your risk. So in Forex, there are different lot sizes. For example, we have the standard lot, we have the mini lot, we have the micro, we have the nano. Okay, so the standard lot represents 1000 units, 1.0 volume, then $10 per pip move. Then mini lot is 10,000 units, 0.1 volume, and $1 per pip move. Then while the micro lot is 1000 units, 0.01 volume, and 10 cents per pip move. Then while the nano lot, which some brokers give, is 100 units, 0.01 volume, and 0.01 pip, dollar per pip. Okay, let's see for example that price moves 20 pips. Now with the 0.01 lot, you make small profit. With 0.1 lot, you make more profit. With 1.0 lot, you make a lot more. Same trade, different money. But mind you, in as much as you are capable of making a lot of money as you are increasing your lot size, this is also true for losses. Now this section is about spread. So what is a spread? When you enter a trade, you don't start from zero. You start slightly in loss because of spread. Now if you look at this picture, you see that euro is the bid price while USD is the ask price. Now the difference between the ask price and the bid price is what gives you the spread. So in this case, the spread is 2.1 pips. Now the next aspect of this lesson is risk management. Now risk is the amount of money you are willing to lose before entering a trade. Now this is what happens when you don't manage risk. You will have big losses, emotional trading, and eventually you blow your account. Now small losses with controlled risk will allow your account to grow over time. Never risk more than 1% to 3% of your account. For example, if your account size is $100, 1% is $1, 3% is $3. However, if you are trying to grow a small account, the maximum I would advise for you to use is 5%. Alright, and that is your maximum loss per trade. Stop loss is very important. Stop loss is an order that is placed above or below your entry point to prevent you from having large losses. Now the distance between your entry and stop loss is the risk, while the distance between the entry to your take profit is the reward. Now it is very important to have your risk to reward, which is the ROR multiple, to be 1 to 2 or 1 to 3. This should be your minimum RR multiple. Now let's look at an example. Let's say you want to enter a trade and you decide to raise $2, right? In order to make $4. This is a 1 to 2 restore reward. Now, for you to be successful in trading, you must have a winning mindset. You must have a mindset that is not affected by losses. You must have a mindset that is backed up with the fact that even though losses comes, I'm willing to maintain my risk management, I'm willing to follow up with my rules, and I'm willing to be patient enough to wait for my setup. I would also like for you to understand that no one is born a great trader. One learns by trading, so never give up.